We are about to see the biggest car market crash of our lifetime. I signed a 3-year lease for a 2019 BMW 540i M Sport back in 2019 for $719 a month. At the end of the lease term in 2022, when I went to lease that exact same model, the lowest quote I got was $1,140. That's almost a 60% increase in 3 years. The prices were astronomical, the inventory was low, my lease period was coming to an end, and I was about to be out of a car within a matter of months. What we are seeing now, that these situations may be coming to an end, but perhaps that may not be a good thing for a lot of people. In this video, I will explain what may have led to these over excessive price hikes, what may cause the crash, who are the people who actually got lucky and made a profit during this time, and who are the one who's going to get affected by this crash the most. Feel free to skip around the timestamp if you would like to save some time. If you don't live in New York or any other state where public transportation is readily available, having a car in the US is not a luxury but a necessity. With rising prices of gas, increasing rate hikes, and people's income not increasing significantly, affording a car became extremely hard for a lot of people. The average cost of a car ownership in the US amounts to $8,876 per year for a sedan or an average car. Back in 2019, I leased a BMW 540i M Sport with $3,000 down and 12,000 miles a year for $719 a month. At the end of the lease term in 2022, I wanted to lease that exact same model without any bells and whistles with same terms. The lowest quote I got for $2,500 down, only 10,000 mileage a year, was $1,140. That's an increase of 58.23% in 3 years. And most of the dealerships were charging $5,000 to $10,000 extra on top of the sticker price and calling that a market adjusted rate due to low inventory. Hi, I'm Tasvir Mirza. I'm a realtor and a diversified investor based in South Florida, and on this channel I make finance related videos less boring. The worldwide pandemic that started in 2020 increased demand for a lot of goods and services, making them scarce and more expensive, including cars. The lockdowns and work from home trends resulted in people not moving around as much and needing cars. The local car dealerships were looking like a ghost town, and which led to an oversupply of cars at dealerships. With people not buying cars, dealerships got desperate. They were practically giving cars away, offering 0% interest loans for 84 months and generous purchase and lease packages to buyers to get the deals done. As the world started to open back up in 2021, a new problem popped up. A global chip shortage. Silicon chips, which are vital for new car production as they operate many car systems that vehicle needs today to operate. Due to the pandemic, the supply of these chips were severely disrupted, and it was believed that automakers wouldn't be able to produce enough vehicles to meet demands for a considerable amount of time. This led to the high demand of used cars. The situation was further complicated when the war broke in 2022, disrupting the production of certain vehicle components. All of these situations have caused considerable disruption to supply chains, leading to a surge in both used and new car prices. The demand for vehicles outpaced the supply, causing the prices to skyrocket. In January 2022, buyers paid more than 12.2% than previous January for new cars, while used cars were up more than 40% year over year. Edmunds reported that 82% of new car buyers paid over sticker price in January 2022, compared to only 2.8% the year prior. According to data from JD Power's, US consumer forked out an average of $46,437 for a new vehicle in January 2023, marking a year-over-year increase of 4.2%. This is an all-time high for the month of January and indicates that no real relief from 2020's record prices. The peak of these prices has likely passed, and the wholesale prices have already been seen to decline, which over the time result in retail prices reducing accordingly. It was expected that it wouldn't take a significant amount of time for the prices to decrease. Wholesale prices have begun to decline, which should eventually lead to reduction of retail prices, right? The benchmark was set so high during the peak of the market that it will likely take years for the prices to come down to pre-pandemic level. However, there's already evidence that car prices across all segments have softened, with data from Cox Automotive showing that wholesale vehicle prices fell 2.4% from the year earlier in March 2023, despite ticking up 1.5% from the previous month. A report from Kelley Blue Book also found that new vehicle prices dropped for 3 months consecutively, suggesting a sustained downward trend, though prices remain significantly high. UBS anticipates a global oversupply of cars in 2023, with production exceeds sales by 6%. This oversupply may lead to price cuts, especially especially in the second half of the year, triggering a price war among car makers, particularly in the EV space. Some EV makers like Tesla have already started slashing prices, with some of its cheaper models now in the same price range as mass market brands such as Kia, and others like Ford Motors and Lucid Motors have also followed suit. And following the price cuts, I have also cut prices of the like and subscribe button below to $0. Press it and grab yourself a pair while supplies last. In the used car market, prices are already starting to drop as the market cools, having seemingly peaked earlier in 2022. Lead automotive equity research analyst at JP Morgan said outside of near-term consumer slowdown, we believe a ramp-up in new vehicle production and subsequent dealer inventory build-up towards normalized level are likely to be the key driver. Used car pricing reversion. The Manheim Used Vehicle Value Index, which measures the prices that dealerships have to pay for the used cars in the auction, hit a high of 257.7 in January 2022, and it has fallen in January 2023. Overall, JP Morgan research predicts used car prices will decline by roughly 10% in 2023. Now, lower new vehicle prices may not translate into higher demands, especially in the light of recent interest hikes. According to data from JD Power, average interest rate for new vehicle loans increased to 6.79% in January 2023, 264 basis points higher than a year ago. 80% of Americans who finance or lease a new vehicle may not experience any relief, given that a 100 basis point rise in interest rate translates to approximately $20 increase in monthly cost for an average of $45,000 for 72 months loan. Now, even in these circumstances, some people were able to make profit by taking advantage of this market. We'll come to that later on in this video. Where the situation turns even worse with the people who has purchased a vehicle during the peak of the market. The sticker price of the vehicle were already high, and not to mention dealerships were charging $5,000 to $10,000 over sticker price. Some of the luxury vehicle dealerships were charging upwards of $100,000 for vehicle over sticker price, calling that a market adjusted rate due to low inventory. Now, cars are a depreciating asset. The moment you sign those dotted lines and drive the car out the lot, the value of that car drops since it already has been titled to you. Most of the people who has purchased during the peak of the market with a temporary influx of their income due to stimulus payment allowed them to afford a car that was already overpriced. Now that the stimulus checks have stopped coming in, we're seeing a lot more cars are being repoed by the bank and auctioned off due to non-payment. All these vehicles are now coming in the market, which also causing the crash. Now, who got lucky during this time? If you would have bought a vehicle or placed an order to the manufacturer and received it right before the pandemic and was able to sell it back to the dealership or aftermarket at a premium, you got lucky. Or you have sold your vehicle during the peak of the market that you've already had in the past, you got yourself a deal. Now, if you already have a car and don't need to purchase a new one, I would wait getting a new car till the market comes down a little bit more, along with the interest rate. However, if you have purchased during the peak of the market, it's better to keep the car and drive it and get some more use out of it. As far as me, I was not able to convince myself to pay a premium for a vehicle and also the market adjusted rate. I ended up buying my lease by paying the residual value for the car, which was way cheaper than getting a new one. The car was under warranty and had low mileage. It was cheaper to keep the car than get a new one. If you're the one who were able to make profit during the pandemic by taking advantage of the market, leave a dollar emoji in the comment section below. And if you're one of those who had to pay for a vehicle during the peak of the market, leave a poop emoji in the comment section below. Let's see what the ratio turns out to be. And as always, if you like the vibe, join the tribe. Thank you for hanging out with me. See you in the next video. Hi, I'm a Tasvir Mirza. I am a Tasvir Mirza. Damn right, I'm a Tasvir Mirza.